truly honored to be presenting once again. Last year when SumZero had their Rising Stars Challenge for the first time, I thought it was a great initiative. I'm really glad that you're continuing the tradition and I can be here once again. I'm gonna make sure that I can screen share here properly. So let's see if this works. You should be able to see my PowerPoint slides on Kingsway. And if it doesn't show up, just let me know if there's a problem.
Looks great.
Great, awesome. Then I'll get going. So I'll be presenting Kingsway this time around. I presented Burford as a long pitch last year, and I see a target price for Kingsway up to sort of $25 per share by 2027. But what is Kingsway? Now, I won't rehash my bio. We went over that, but if after this presentation you have any questions whatsoever, you can feel free to contact me at my email. Now, Kingsway or KFS is essentially a holding company with two different segments: extended warranty operations, which are the predominant part of Kingsway today, and then a search fund platform. But that's getting all of the incremental invested capital, so it'll become the largest segment in just a few years. The company has had a troubled past or a complex past, but this all changed in 2018 when John Fitzgerald, or JT, joined as CEO and completed a full-on transformation of the company. He simplified the operating structure, the balance sheet, the capital structure, and pivoted the company after that to the search platform, which has been sort of where most of the value has accrued since he joined. But what is a search fund? I mentioned it two times already. A search fund is essentially an investment vehicle where a searcher, often a young MBA graduate, is able to acquire an existing cash flow generating business to improve their operations. If you're not wanting to do a startup or don't have a great sort of idea or program is key, acquiring an existing business is a good choice, and the search fund solves for this issue. Now, before I go into my thesis and why I think this might be a good opportunity, why should you care? So I just want to go over a few things that make this a compelling setup for a potential mispricing. Talked about this veil of complexity, and Kingsway has this full on. They have a very poor historical earnings visibility. If you look at their historical financials, you can't tell a lot from them. The company as it existed in 2018 is very, very different from the Kingsway we see today. So financials are not a great measure of future performance. It's also a microcap with a very limited float. The public float is less than $80 million. So that severely limits the type of investor that can even contemplate buying into this company. There's few natural buyers. So that's a great structural setup. But then you also have a product that's valuable. Like the search platform within Kingsway provides searchers with a more efficient approach to sourcing and acquiring a business without having searchers needing to give up anything in return versus other alternatives. So it's the so-called obvious choice in the industry. So that's a valuable asset. Then this allows them to have high returns on incremental capital, which will allow for compounding at a high rate. And you also have very aligned shareholdings or sort of aligned ownership with management, since the management and board of directors own over 60% of the company. Board members have purchased all of their shares with stock, and the CEO owns just over 7% directly. So, but how did we get here? Because the transformation is worth diving into. So since JT became CEO in 2018, he has embarked on a 5-year mission to reposition Kingsway from the opaque and complex merchant bank that it used to be to an acquisition platform for entrepreneurs to acquire small, capital light, and non-cyclical companies. The first thing JT did when he joined was that he sold that insurance business that had plagued Kingsway for over 15 years at that point. They also purchased another extended warranty company called PWBSC for 10 million, and they subsequently sold it just 4 years after for a 10 times return. Purchased for 10 million, 5 million equity, sold it for 50 million. So that was a great early indication of the search sort of platform playing itself out. There was a lot of other balance sheet oriented and capital structure oriented solutions that were made. So they divested part of a rail yard, CMC Industries, which removed a lot of debt on the balance sheet. All of the real estate holdings that Kingsway had from previous management was also sold off. And the trust preferred security as a type of debt obligation was repurchased at 61 cents on the dollar. So that again removed a lot of overhanging debt that Kingsway had. Finally, they converted preferred stock and they excised the warrants that they had outstanding. So Kingsway today is now a very simple company from having been a very complex company in the past. You can see some of the results here. After Kingsway as an insurance company failed after the great financial crisis, Joseph Stilwell, who's the largest owner today, came in, pursued an activist strategy, sort of became a failed decade for Kingsway as the merchant bank approach didn't really work for several reasons. And then as JT came in, really restored the balance sheet and has reduced debt by almost 300 million, which is quite impressive. The search fund part here will be the most information dense part of the presentation, but I'll try to go over it quickly. So why are search funds even attractive? A Stanford study that's very frequently cited collected data on all of the traditional search funds that they could find, and back from 1984 onwards, and saw that both a little bit above 20 billion of capital, these funds have generated an average pre-tax IRR of 35%. It's not an obtuse, weird IRR metric, as the money on capital was also high at 6 times. And there are pretty structural reasons why you're able to acquire companies at low multiples here, which is why the high returns exist. Usually it's due to the company being very small, so 2 million to 10 million total purchase price consideration, 500K to 3 million in EBITDA. The seller's motivations, as you will acquire the company usually from a retiring founder that doesn't have a clear successor. So a search fund or Kingsway is sort of successor capital, and they solve that issue for someone who really cares about their company, while they might not want to sell to PE because they'll just rip it apart, or they won't manage the relationships in a way that their founder would want them to do. And similarly, it's a complication with the founder almost always being the CEO. So if you're a outside acquirer like a private equity company, you really need to have a clear CEO coming in, and that's not always the case. Just acquiring these companies then, small companies that are capitalized, which is always the key, at 5 times EBITDA, then you're getting a 25% IRR just from cash flows. So an eventual sale can bring that up quite further. Kingsway is in this business to begin with because of JT, the CEO, who was a searcher early in his career, had a search fund for a long while, and when he was tapped to become CEO of Kingsway, he had Kingsway decided to acquire his search fund so that he could pursue that and honor his promise to his LPs while also restructuring Kingsway. And as it happened, as Kingsway got more and more capital to deploy, he decided to build out a search fund under the Kingsway umbrella. And here's what I think sort of is the real value of the search fund platform, because KFS, which is the search accelerator within Kingsway, really provides a better value proposition than traditional search funds can. And I think that's very valuable. So they have decided to try to automate a lot of the administrative and time-consuming tasks that searchers would otherwise have to do on their own. So a searcher will just be themselves operating as a one-man shop and raising capital for 5, 10 to 20 other investors. Going through Kingsway, they just have one sponsor and they get all of these tools to reduce time spent on things that are not worth their time. So that's very attractive. They also support their searchers after acquisition. They have an advisory board of William Thorndike. He's not only the author of The Outsiders, but he's also a prominent search fund investor. Is very much key in this ecosystem of search funds. And the board also consists of Tom Joyce, who's previous CEO at Danaher. And so he has a lot of things to advise on for the searchers. Now, those advantages are good in and of themselves, but what's key is that a searcher gets this at KSX without having to give up worse terms. There's an industry standard that almost everyone follows, where a searcher can get up to 25% of the company, starts at 8.3%, and it vests in third increments depending on performance and duration and whatnot. And so KSX matches these terms that someone would get at a traditional fund. So there's no real reason for them to go the traditional route. And so I'd say that I don't really see a reason why someone wouldn't choose Kingsway. And the results are pretty indicative of this, as they gain over 100 resumes per open search slot. So I think that's a pretty early indication of the attractiveness of the platform. In terms of what they want to acquire, they want to do 5 to 7 times EBITDA, and this is in the historical range, which I will talk about. Industry set, while they are sector agnostic, because of the business criteria that they're pretty rigid on, like highly recurring revenue, capital light operations, high margins, low obsolescence risk, stuff like that. They tend to bucket themselves into very specific industries like VMS, healthcare staffing, or just outsourced services in general. So that's the general framework. They want to do 2 to 3 acquisitions per year. That pencils out to having around 4 to 5 searchers at the same time. They take on average 1.5 years to find a business to acquire. And on average, they're looking to buy 1.5 to maybe 3 million in EBITDA per acquisition. So if you scale that up a little bit, 4 to 5 acquisitions, they could do up to 5 million or 50 million in annual EBITDA, a revenue that they could acquire, which would translate to 10 million in EBITDA. And I think that's what the platform currently is supporting, and that could definitely expand further because they have a decentralized acquisition structure here that I think is really important because usually one of the main hurdles of acquisition-driven companies is the scalability of the M&A approach. And here you have a structure where the search process is fully independent. So every searcher is using their own approach to find investment opportunities, and sure, they can get help from Kingsway as much or as little as they want. But that decentralized deal sourcing, and that allows them to fully focus on what they're doing, and then you can increase the frequency of deals. I would also add that there's an emerging platform effect here. When Kingsway acquires additional companies, they can, after they gain a little experience, do tuck-ins. So the roster of companies that they own can then by themselves do internal M&A. And so that again increases the frequency of deals without having to necessarily increase the acquisition size. Looking at the track record, the first 6 acquisitions they have done, we have closed 5 and should close this 6th pretty soon. That has yielded a 27% return on capital, assuming a 21% tax rate. Now, the cash on cash returns are much higher here as Kingsway doesn't pay taxes. They have a very large NOL or large net operating losses that will continue out to 2029 and beyond. But even accounting for taxes, you're at 27% return and mid-30s without taxes. Now, high returns are always great, but you need to be able to deploy more capital. And here, Kingsway has over 20 million on the balance sheet, and they generate cash on a yearly basis, giving them around 28 million to spend on future acquisitions in 2024 and 2025, should they want to. And you can see my assumptions here is just taking the run rate EBITDA of the companies currently under their umbrella, and then the corporate cost that I have estimated, and you see that the free cash flow and the cash balance adds up to 28. Now, getting a little bit more specific, what the acquisition math pencils out to here. They deploy most of their cash flow, over 90% of the cash flow each year into search fund acquisitions, doing equal pieces of equity and equal pieces of debt at a 5 times EBITDA multiple. You're going to grow segment EBITDA, so before corporate costs, from 18 million to 68 million by 2027. So almost a 300% increase and a over 30% compounded annual growth rate. And you can see I have assumed that this is a pretty capital light operation with high free cash flow conversion, pretty decent organic growth. And I definitely believe that would be possible. And it's sort of indicative of what's been happening in the past. Now, you always want to be skeptical of graphs like this that go up and to the right. So a little bit more specifically here, I think that they'll acquire 6 million of EBITDA in 2024, and that could scale up to 20 million in EBITDA by 2027. And that would be a little bit of a different structure from what they're currently doing. It would require them to scale up the amount of acquisitions they do per year and increase the size a little bit. We don't really know exactly what the like entity structure is going to be like in 2026 and 2027, but it's fair to say that they have a lot of opportunities to flex where the acquisitions. So we'll see exactly what they do. I haven't gone into the businesses yet, and I'll do that very briefly, and we can ask more questions on it if you want. But the extended warranty companies are pretty decent capital light, high cash flow conversion businesses. The poor thing, if anything, is that they're kind of sort of limited in growth. They're growing to 4, maybe 6 percentage points per year. And so these companies are primarily used to harvest cash to fund new acquisitions for the search fund. But they're good businesses, recurring revenue, local barriers, pretty capital light. They use reinsurance for most of the risks. So they're decent companies. In terms of the search platform, they bucket the existing operations into 3 categories. First is business services, mostly outsourced accounting. So think like accountants for visa-backed startups, even other search funds that are just getting started, or interim CFOs, stuff of that nature. Healthcare services, it's also primarily outsourced services. We have an outsourced staffing company in SNS, and then DDI is an outsourced cardiac monitoring telemetry service. Now, I think this is a very interesting company. They've grown over 20% per year organically over the last 3 years, and they've only penetrated 10% of the market. They have a huge backlog that they could increase revenue next year by 40% if they would want to. So that's an intriguing company to follow within Kingsway, but I won't talk more about it. Then on the VMS side, they have a tiny, tiny company here called SPY that develops software for the timeshare market. But Kingsway is using SPI more as a sort of first little step into VMS, and they hope to build out this platform into a much bigger piece of the company. The search fund as a sort of that platform as a whole is doing 50 million in run rate revenue here by 2023, and should continue to grow at sort of decent clip, 3, 4, 5 percentage points per year. And they're very capital light and therefore can send 8 to 9 million of annual cash flow up to the company. I want to highlight this risks. If I go back to the previous slide, you see that from 2022 to 2023, outsourced services saw a pretty big decline in their sales. So both Ravix and C-Suite, which are the outsourced accounting services, they're very much sensitive to capital markets activity, how many deals are done, how much money is raised from VCs, and as interest rates shot up, this hurt them a little bit. So you can see that the quarterly results, as revenues are decreasing, you're seeing some margin compression. That's worth it highlighting and keeping an eye on. But despite that pretty large decline in sales, to be fair, they still have a mid-teens EBITDA margin. And I think as the founders or the new entrepreneurs, I should say, continue to optimize that business, I think they'll grow over time. Valuation is the most important part of the pitch. And the way I approach it is I begin with the segment level EBITDA, 67 million. After corporate costs and all of the interest expenses, you get a free cash flow of 36 million, and that is after tax. Because even though they won't be paying tax, I want to capitalize everything on an after-tax basis. Gives you $1.4 per share in free cash flow. A 20 times multiple on that would give you a 700 million market cap. The implied EBITDA is 14 times. The company will be 2.5 times leverage at this point, net debt to EBITDA. And to add to that, I then sort of use the present value of the NOLs that are still ahead of us from 2028, that is, to 2037, and then you need to subtract the searchers' equity interest because they can vest, as I told you, from 8.3 up to 25%. So I'm assuming that the average in a few years is 15%, and that would be value that accrues to the searchers and not to us equity holders. Final value then of 660 million or a $25 share price. That's around 200% above the current $8.6 share price. And if I look at the market, I think Kingsway trades at 8.8, so 8.6 is a little bit below that, but I kept everything the same as the original pitch to try to make it consistent. I will note that I have reduced my upside from previously when I first pitched it, as I went through all of my assumptions and sort of redid things in my model. And I added, for example, this searcher's equity interest, which I think is fair. So I was too aggressive with some of my assumptions previously. So this new revisited valuation still has a 30% IRR. And what I think is very great here is that the downside case or I assume that they don't deploy a lot of capital and they don't generate a high return. You're even getting a decent IRR there. And I don't think that scenario is very likely. So look at what we have here. We have a company that can reinvest at high incremental returns on capital, that's getting more diversified as they acquiring more companies and therefore reducing risk. So a high rate of compounding coupled with decreasing risk should make wonders for multiple expansion. So I think it's highly likely that they even trade at above 14 times EBITDA multiple by 2027. I can think of several comps that trade at 15 to 25 times. And a very similar one would be Chapters Group in Germany that trade at 18 times. So there's room for expansion, I think. But I leave it at that. That's the pitch, and I hope to answer any of your questions.
Alexander, that was great. We've had the pleasure of being able to look through this for the past couple of months, but I really appreciate you walking us through this. To everyone that is on the line, if you do have questions, we have a couple of minutes. Feel free to toss them in the chat. It actually looks like we already have one. Is Kingsway a serial acquirer like Constellation Software / Topicus? Do they have many competitors? What advantage do they have over them?
Yeah, I would definitely draw that similarity. Though, since Constellation Software would be strictly in VMS, they're not exactly the same. The business characters will be a little bit different. So I would focus on the search fund aspect here. That is a very sort of specific niche. It's just not acquiring a company, but it's really providing that solution to an entrepreneur that wants to acquire a company. You usually need a lot of strong sort of connections to Harvard and Stanford. That's where most of the search funds originate from. And the Kingsway has that, and William Thorndike has sent him a searcher to. And they actually, the people that teach search funds at Harvard are also investors. So yes, they have an advantage sort of that way. And I think all of the attractive parts of the search fund that Kingsway can offer that a traditional search fund cannot. I think that gives them an advantage in the searches that they can attract, and that by itself should have a positive effect in outer years as those searchers improve the businesses that they operate.
Awesome. What percentage do they take off the entrepreneur for their search fund service, and or how do they get compensated?
Yeah, so Kingsway is the one deploying sort of the capital. They provide the capital, and so it's sort of an equal. They both want the same thing. So Kingsway wants to give what's the highest return, and Search Fund also wants a good partner. But Kingsway has a few preferred return hurdles that I don't believe are public, so I'm not sure what those are. But after those hurdles, they get accelerated, so equity stakes until they get their hurdles. So the searchers are the ones mostly compensated, getting up to 25%, but Kingsway has a preferred share amount in the beginning, although I'm not sure what that is specifically.
Got it. We have one last question. What is the justification for a portfolio of companies that was acquired for around 5x being valued for more than double that multiple within Kingsway?
Yeah, a common question, and I think it's definitely a justified one. Key is that they are acquired not because they're worth 5x EBITDA in and of itself, but a lot of those structural reasons. They're small companies, so if you just own one of them, it'd be highly risky, and it's not a real company if you're not willing to be the founder as well. The company doesn't really exist. These are small enough to where there's not strong moats if you don't execute properly. So therefore, it's a big time commitment. You can't really just acquire it and own it. You have to work on the business. So that explains parts of it.